Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Thursday, August 29th. Hope you're doing well. We are here getting right down to the finish line of summer. Thank God. As I think you know, I'm not a summer guy. Last couple of nights, it was chilly here in the New York area. It was great. Actually, I put a sweatshirt on, sit outside with the fire pit, smell of, the other people in the neighborhood doing the same, and nice smells in the air from whatever they were burning. Yeah, I know, CO2, I get it. So this time of year that I really look forward to, right? I love the football seasons here. We've got college football started, getting down to the last preseason football game, and then we get into the regular stuff. Just got my tickets, taking my son to South Bend, Indiana. We're going to watch Notre Dame USC play in October. Touchdown Jesus. So we're looking forward to that. And Notre Dame USC is a huge rivalry, so we're pretty excited to go there. I've never been to I'm a monster football fan. Played from the time I was 7 through high school, and then huge football fan. Love it, and huge college football fan. And like, I'm an analyst with numbers. I'm that way with sports stats, and I could go back to years and years and years. Huge Notre Dame fan, and I have never been to a Notre Dame football game in person, so pretty excited about it. And my son's pretty jacked up too. So we got that. We bought all that and got all the details out of the way there. So got the Mets still in the hunt for a playoff. Cooled off a little bit. Lost 4 in a row, kind of pissing me off. But they had such a torrid streak, so it was bound to cool off a little bit. Got NHL hockey. Camp ready to start here pretty soon. Man, what a great time of year, the fall. And so we're going to. So we got a lot to look forward to on that front. And we talk a lot about my view on different industries. My market view, I might share it a little bit not too long ago on one of the podcasts, but typically I don't, the main market I'm not really too focused on. I'm looking for areas of inefficiencies, things that are down and out, that are beaten up, that are, and many, industries, companies that are beaten up and left for dead, they deserve to be. And so it's hard to find those industries where, you start to see some inflection points. You have to be patient. You have to wait, right? So, and I talk about, it's not that I wait. I'm not looking, I don't have to make money on it right away. It could be a year, 2 years, longer. If I think the risk reward, if I think my upside is dramatic versus what the downside is. And then, but so if the risk reward is poor and you got a lot of downside, well, then you're kind of crazy. But if your risk reward is so dramatically skewed to the upside, I'm talking 3 to 1, 4 to 1, 5 to 1 and higher, that's attractive. And when those potential are big multiple returns, and your downside is 20, 30%, whatever it may be in any industry you're looking at, but the potential is for much more. That's a different style of investing. It's not for many people because it's not popular. It's not going to, you're buying things that are out of favor. You're going to have to wait a long time or, the catalyst. But if you feel as though that the downside is protected, the upside, when the fundamentals turn, will take care of themselves. So it's always focusing on what that downside is and looking for those type of things. And, you start to learn over the years that in these deeply cyclical industries, you just got to learn the nuances of the industry, but it comes down to math. It's supply and demand, right? And, supply, what is the marginal cost of production, or how many companies are producing above that? How long can they afford to stay in production? What's the price they're getting for selling it? And you start to, you start to interchange these things in, right? So, you people know, I spent a lot of time in uranium, and that's we're not going to talk about uranium today, but it's in different industries, you start to look at these type of things. And, when you look in one of the industries where you tend to see dramatic moves, and by the way, these are not great businesses, right? So like mining businesses are not good businesses. I had a buddy of mine who was a former partner at one of my hedge funds, and we were talking, and he was looking at some of the numbers on the mining companies because he's getting excited about the potential turn in uranium, or the turn in uranium, not the potential turn, what has already turned, just the equity market hasn't figured out. But saying, I'm not sure that these are great businesses for the long term. I said, dude, what planet? He's a bank analyst. I said, what planet are you on? You've been doing this 25 years. These are cyclical beasts, right? That move up and down with supply and demand. And because of human nature, when there is too much of something, people discard and throw it on the trash bin. And when there's not enough, they come out of the woodwork and buy this stuff, right? And because the vast majority don't do the work, it's the 80-20 rule, right? You tend to, you're left with headlines and news flow and money flows and who's coming in out, what company's coming in and out of an index, whatever it might be, but it's not the fundamentals that are the focus. And because of recency biases, right? Things are in short supply. All of a sudden, we got to buy it, and oh my God, the narrative changes, and there's never enough of it, and it's never going to be enough. And I could paint a picture and tell you why things are going to be so fabulous, and it overshoots, and then it comes down, and then you have periods and years where things are shitty, right? So you go from glory days to shitty days, and then all of a sudden, when the capital dries up for the industry and companies are making stuff or producing stuff or pulling it out of the ground, whatever they're doing, and it's costing them a lot more to do that than they're selling it for, they cut capacity, and then it goes through a bottoming segment. People say, well, it's, they needed to do that. And then it starts to happen, and company stock prices have been depressed and hammered, and people it's not popular because they could look at WeWork or Beyond Meat or anything else that's working, and it's cool and it's growthy and it's great. And all of a sudden, that's where people's interests are. Or you got the gold bugs who are always looking at gold. So in these deeply cyclical industries, it goes from euphoria to depression. And then when things are really depressed, right, that's when you want to start looking. And when things are really euphoric, you want to get out. So I said to my buddy, no, they're not great businesses secularly, year after year after year. When they earn, they over-earn. And when they don't, if they're well managed, hopefully they under-earn, but they don't blow themselves up. And he's like, yeah, no, I get it. But in looking at that, as you look around the industries right now, you've heard me talk about my oil and gas views and how the shale plays, where they've been because of free money, basically because of low interest rates. They've been not free money, but very low interest rates. Have been able to go out and borrow till the cows come home and lever up those balance sheets and grow and produce and cash flow suck. Right. So, and then after a while, it's been a long time now. It's been almost a decade, and you can only have so much debt where your production rates are slowing, and your cash flow, no matter what the price of oil is for 3/4 of them, they don't make money. Right. At some point, the cows come home. They come home to chickens come home to roost, and that there's my view. Right. And so in that area, where has neglect been? Well, it's. Gosh, everything's focused on the onshore shale plays, right? So where are people taking it from? That capital. So that capital's come out of offshore, and the services companies and the drilling companies and the rig building, and you name it. Anyone that has to do with that, their prices have been crushed and destroyed. People have run, and all of a sudden you're looking at companies that are trading at well below tangible book value. And you look back, well, where did they trade in a prior period? And they were a shit ton higher. And what's it going to take? Well, it's going to take capital that has been starved in that industry. It's projects have been canceled, and money has been put into the shale plays. And if that starts to slow, and people realize, well, we still need to find a lot of oil every year. Where's that going to come from? All of a sudden, it rotates back to the other, and people wake up one day and say, "Oh God, look how cheap that is." And that's what happens. I mean, that's the nature of it. So, but you're going to go through long periods of time where, the market's going up and you're doing nothing because your sector's out of favor, but it might be bottoming and it might be a great risk reward. So who cares what the market's doing? What are you going to do? Fight and struggle and read the headlines and battle and figure out, is the S&P from here? Is it going up 10 or 15%? If it's wrong, is it going down 20? Is it going up 30% from here? Probably not. Could it go down 20, 25? Maybe. So what's that risk reward? Your upside downside, what, 1-to-1? How is that exciting? Right? If you catch a shipping cycle, or if you catch an offshore cycle, if you catch a uranium cycle, right, and you got to wait a little bit, but your upside downside is 4 or 5, 6-to-1. You're talking hundreds of percent versus not, but it's lumpy, right? So it's hard for institutions to jump on that because they need more consistent performance. But if you're looking for really significant returns, and again, it doesn't happen overnight. And again, there's downside at first because, markets, when they're bottoming, it's really hard. It's just like you can't go short these things at the top right away. You can't load the boat because they could go on a lot longer than you think. But that changes. So one of the sectors that has caught my attention recently, and really there have been a couple of guys that have brought it to my attention, and the one is two buddies of mine. One is Chris McIntosh out of New Zealand. God, he lives in a beautiful part of the world. He sends pictures like Jesus. But McIntosh runs Capitalist Exploits and Glenorchy Capital. And I have him on the podcast. He's the one with the funny accent. Smart as a whip, big macro guy. Always looking for blown up industries. Doesn't do a lot of shorting. But he's very patient, very value oriented. And the other guy who's actually going to be in studio here very shortly when his Uber gets him here is Harris Kupperman, otherwise known as Kuppy. And he puts out, he has a website called Adventures in Capitalism. It's that.com, adventuresincapitalism.com. And he also runs a hedge fund called Praetorian Capital. And same philosophy, very deep value, very looking for, companies at bottoms, shorts, occasionally, not a lot, doesn't do a lot of shorting. He shorts companies that he thinks are going to implode, but he'll do it through puts. He'll express. He could talk to you about that when he's here. But he has in the past made money doing it, and he's really, really focused on it now. And one of the areas is, the shipping space. And the more I've read, the more I've really been very intrigued by it and think there's some significant upside. And with Kuppy and McIntosh, Kuppy will pick my brain on uranium. He can ask me as many questions as we want. We're friends, and I'm happy to chat with him. And then I'll get and on shipping, I'll pick his brain. And I thought it would be fun for you to listen to me ask him a lot of questions about shipping here. But his view is that there's really just a confluence of factors that mark a bottom in this sector. And he thinks there's just a significant recovery at foot, and and the reason it's kind of like why now is you're starting to see it. This comes down to supply and shipping rates, and these stocks that are trading well below their tangible book value, and he wrote something I thought was pretty interesting, and I just want to find it. He says here, if I told you last year that Trump would initiate a trade war with China, you'd have likely expected the spot charter rate for a container vessel from China to Long Beach, California to decrease. What if I told you the rates are now at 7-year highs? I like to throw this fact out because it shows how wrong conventional wisdom can sometimes be when applied to finance. When you can find a moment where conventional wisdom intersects with factual data and the two disagree, you usually find a mispricing in the equity markets. Think about that. I mean, that is just so well said. When you can find a moment when conventional wisdom, consensus, how the equities are trading now, intersects with factual data and the two disagree, you usually find a mispricing in the equity markets. When conventional wisdom eventually catches up, you have the opportunity for huge percentage gains, particularly when you're dealing with a security that has massive operational leverage on top of financial leverage, especially when the fundamental story keeps getting better. All bull markets in cyclical sectors start with long periods of investor losses, disgust with the sector, and a lack of capital for companies to add new supply. The 11-year shipping bear market from 2008 to 2019 has all the hallmarks of a typical cyclical bottom, complete with a wave of bankruptcies, massively diluted capital raises over the past 5 years. Banks took epic losses and stopped lending capital for growth, while shipyards closed up or consolidated. Even if the industry wanted to resume rapid growth, there's no one willing to fund vessels, and new build prices are much higher following a massive wave of consolidation. Besides, most yards are booked solid with scrubber installations, and we'll talk about that. New build orders, supply, right? Think of it if you're a mining bug, think of it as mine supply. In shipping, it's new build orders. Right? These are long life. It takes a long time to build these things. In 2013, there was 2012-13. There was $20 billion spent on new vessels. That went up to $33 billion. Towards 13. I'm sorry, 13 was 20-ish billion. Then you had $35 billion spent in 14. Huge amounts of capital. Today, growth in global new build orders, total dollars spent, less than $5 billion. Number of vessels, less than 100. Back at the peak, 800. Supply is drying up. And Kuppy says, if you reread some of my pieces from the winter, my main thesis was that IMO 2020 was a gating function. That's a regulatory CO2 burn thing that's coming in. I've talked about it before. We'll talk about it with Kuppy. That would necessitate that old tonnage gets scrapped. Meanwhile, newer vessels would have scrubbers installed and have insurmountable cost advantages. Putting this in perspective, depending on the spread between high sulfur and low sulfur fuels and transit speed, a Cape-size bulker with a scrubber could easily have a $10,000 daily cost advantage compared to a 20-year-old burning low sulfur fuel. When you realize that spot charter rates were as low as $5,000 a few months ago, and you see that the old vessel is no longer in the ballgame anymore, it isn't even playing the same sport. What I didn't predict was the bottlenecks at the shipyards related to scrubber installations. As a cyclical market starts to recover, supply and demand tend to roughly balance. Then there's usually an unanticipated catalyst that takes a tight market and pushes it into a bull market. Depending on which shipping company is lying to you, they expected scrubber installations to take 20 to 30 days. We're now looking at 40 to 60 in reality. When does anything ever go on schedule with a new technology? What's really blown out charter rates was the fact that scrubber installs were supposed to be happening on a set timeline. Suddenly, vessels are queuing and waiting days or even weeks before the shipyards get to them. Supply is leaving the market at a time when demand is inflecting positively. We're not just seeing rate recoveries in containers. The Baltic Dry Index just hit a 5-year high. Very large gas carriers, VLGCs, just hit a 4-year high. VLCC rates just quadrupled from the lows earlier this year, and last summer is seasonally VLCC's weakest period. But he goes on to say, most important for me, LR rates also doubled in the past 2 weeks, following an extended lull while refiners were offline preparing for the new LSFO mandates. Rates are now roughly twice what they were this time last year, and the stocks are still dramatically mispriced. So we're going to bring Kuppy in to talk all about it. Kupp, how are you?
Good. How you doing?
Good, man. So I just read your stuff, the August 20th piece that you put out.
Oh, great. Thanks.
So let's start, but let's go back. Tell people who you are.
Okay. Where should I start? God. My name is Harris Kupperman. Everyone alive calls me Kuppy, except my wife and my mom. I've been publishing a blog called Adventures in Capitalism for about a decade now, where I write about my adventures in finance and business. And I've taken a unique interest in shipping lately, having followed it for almost 20 years. It's an interesting sector, I think, because there's not a lot of specialists.
And you run a fund called Praetorian Capital.
Correct. Yeah, I run a fund. Yeah, thanks for the marketing pitch.
Yeah, sure. Why not? Kuppy braved the torrential downpour that we're having here on Long Island to come to record this. So we appreciate that. So, all right. So I was talking about shipping. I read the piece that you were just talking about. And one of the things, Kuppy, I was talking about was cyclical industries, how when it's really ugly, people tend to forget about it. It's left for dead.
Right.
I mean, so talk about your history with investing in cyclical industries and what got you interested in that and how you think about it.
So cyclical industries are interesting because they have cycles, and every industry has a different cycle, different time frame. And you have to be a historian and look back at what's happened in the past to see what's going to happen in the future. I'm actually a history major, not a business major.
Oh, there you go.
I actually went to university and studied Roman history, and I'm still waiting for the bull market in Roman history. But these sectors, they all repeat themselves. And what's so interesting about cyclical sectors is that you don't buy it when it's collapsing. You don't buy it when it's making new lows. By the time it starts recovering, unless you're in something like semiconductors that has a billion eyeballs on it, everyone's forgotten about it. Yeah. There's no trading volume. It's been in a nice tight range, kicking around the bottom, usually for years. And it's just forgotten about, which means you don't have to be all that smart. And you don't have to bet, is it going to turn next week? Is it going to turn next month? And if not, I'm down another 20%. You can literally watch it turn, like what's happening in shipping right now. And you can watch and have confirmation in terms of what's happening in the industry itself. I mean, shipping's amazing. You have charter rates hitting 5 and 10-year highs right now, and most of the equities are 10% off the all-time low.
So let's stop there. So that's a great example. So, and you wrote about in the piece, right? So all the trade wars, people think trade is going to slow down, yet rates are going up.
Yeah.
So the headline readers are going to not even bother to think about shipping.
Well, they're probably shorting shipping because they think it's going the other way. But let's continue just on the cyclical sectors, because it's important, because I've been doing the same thing for 20 years and I've been doing it well, and along the way you get to have some battle scars like I just had with nat gas. And if you've made too much money too fast and had too many good years in a row, the trading gods need to humble you once or twice. They always do.
That's what they're there for.
That's what they're there for. Or as my very good friend calls it, mother market.
That's it.
And so you have a situation where, with these sectors, you don't have to buy them as it's making new lows. You don't have to really be a chart pattern reader. You don't have to, they all follow the same pattern. There's too much production of something. Either supply has to catch up, either demand has to catch up to supply, or supply gets destroyed, or usually a combination. You can wait for the bankruptcies, the restructuring, supply, depending on the industry. For instance, in shipping, vessels usually aren't destroyed. They just change hands and consolidate. In something like shale oil, supply actually gets destroyed because there's a deep trail off in terms of production. But you need to wait till there's the supply response and also the demand response. Having done this a long time, the trades that are led by an increase in demand as opposed to a destruction of supply are always the better ones, because the supply side never catches up if demand is growing fast. You can't just destroy supply, as we're looking at, like with coal, for instance. You can have a couple-year recovery, but then it just starts making new lows. So anyway, I've been doing this a long time, and they all look the same on the way up, which is that there's been 3 or 4 false starts. Everyone's shell-shocked. The insiders in the industry are shell-shocked. As soon as they start getting cash flow, instead of rushing to increase supply, like they did the last 3 cycles and getting themselves burned, Instead, they're just focused on deleveraging, which is kind of funny because they really should be adding supply or consolidating and buying out their peers, but they just delever. That's the first thing. Then they buy back stock. And the insiders themselves don't believe the recovery, which is why these recoveries tend to last longer than you expect them to. The highs are higher than you expect. Also, why the lows are lower than you expect.
Yeah. And when Kuppy's talking about delevering, he's talking about reducing debt on the balance sheet.
Right. Do you want to talk shipping?
Yeah, man. So, all right. So let's talk different categories of shipping, right? Because people might think shipping is shipping, but there's so many different things, right? There's product tankers, there's
dirty tankers, there's bulkers, there's LPG.
Liquefied.
There's basically 7 main categories, subsectors, but then there's parts of subsectors as well. And each of these has their own supply-demand dynamics. Partly caused by you're not going to take a very large vessel on a short run. Some ports can't take large vessels. There's lots and lots of different characteristics, which means that for a guy who specializes in this sector, people can look at shipping as this monolithic thing. And in reality, that's just the wrong way to think about it. And you could have subsectors that are doing very well while the other subsectors are doing poorly and vice versa, which gives you a lot of opportunity to make attractive trades because so many generalists just think of shipping as this big thing.
Yeah, they're a big monolithic industry. So how do you, right now, I mean, how are you prioritizing your research, your investing, and what's attracting you to those subsectors within shipping?
Well, right now, we're having something called IMO 2020. And what IMO 2020 basically says is that starting January 1 of 2020, all vessels have to burn low sulfur fuel. That's fuel that's less than 0.5% sulfur content. Or they can install scrubbers and burn high sulfur fuel, which is substantially cheaper, about $200 to $250 a ton cheaper today, and likely even more cheaper. That's probably the wrong word, but at some point in the future, that's in January.
You're a Roman history major. You're not an English major, so don't worry.
Yeah, I could barely talk half the time. But you have a situation with the sulfur fuel where a large percentage of the fleet is going to install scrubbers that can burn the cheaper fuel. And then a large portion of the fleet, because most vessels last about 20 years, and the scrubbers cost $3 to $5 million to install, it's not cost effective to install them. So a lot of the older vessels will become obsolete. They're already, basically as time goes on, fuel efficiency gets better in vessels. And so older vessels get scrapped because they're less fuel efficient, and fuel being about half the operating cost of a vessel, which makes it, less competitive to charterers. We just had a stair-step function a few years back with eco vessels, which are dramatically more fuel efficient than legacy vessels. And now you're going to have another stair step with people who install scrubbers. So what it's going to do is legacy vessels that are non-eco vessels, so 8 years or older, are increasingly going to be obsolete. And I think you're going to see a lot of these vessels get scrapped. Or what's going to happen is they're going to slow steam, so they use less fuel. It's kind of like if you're driving your car, if you drive a bit slower, you use less fuel per mile. And
shut the AC off and that type of stuff.
Yeah, exactly. So, but if you slow steam, the number of vessels on this planet is pretty fixed. So if you go 10% slower on average, then you need 10% more vessels. And what that's going to do for the industry is small changes in the vessel numbers have huge changes in charter rates. And additionally, you have the situation where the cost differential of using scrubbers versus being a legacy vessel for, say, a Capesize, it might be as much as $10,000 a day. Which, when you think about the fact that these vessels were only having $5,000 a day of revenue, you realize that anything that doesn't have a scrubber is basically obsolete on day one. They'll either go slower, in which case you need more vessels on this planet in order to move the ton miles needed, or they'll get scrapped. But in either case, what's going to happen is you're going to have less vessels, demand's going to stay constant or grow slightly because it grows slightly every year, and you're going to see charter rates increase. And charter rates are totally independent of what happens in GDP. It's somewhat independent of what happens in supply demand of individual bulk commodities or oil or whatever else. They're fully determined by supply of vessels. And we're entering a new super cycle in that you have this IMO 2020 as a gating function, which is going to take a lot of older legacy vessels, particularly those that are 15 years old and plus, and force them to be obsolete on day one. And I think when you have that much fleet destruction, you're going to have a huge response in terms of charter rates. And charter rates, 99% of that revenue goes to the bottom line.
So when we talk about supply demand here, when I think about uranium, I know how many mines there are. I know the primary mines, pounds. I know the secondary supply, all the sources, and I know how many reactors and the demand. And we have our own numbers, and then there's consensus, which is backward looking. And that's why we think the opportunity exists. How does one think about supply and shipping? I know you put a great chart in there in your last piece on August 20th about the supply of vessels, but are there shipbuilding yards? I mean, how do you track this stuff? I mean, how do you think about it?
Well, there's expensive services like Clarkson's that'll sell you a lot of data. I basically use secondhand data from people who lifted off Clarkson's. I'm a value investor, right? But I think conceptually the way to think about this is that we peaked out in 2008 in charter rates. We're now year 11 of a bear market. There's been a few false starts along the way, particularly in 2012-13, where they ordered a lot of vessels, which were delivered 2016 and absolutely crushed the industry. And what happened in 2016 onwards into 2018 is that pretty much everyone broke in the industry. Every single player either went bankrupt, got bought by someone else, raised equity so that they diluted 95%. Whatever happened, it was a global margin call in the industry, and it reconfigured everyone's balance sheets and scared the hell out of everyone. And since then, there's been a real decline in ordering. You've seen ordering really just to replace vessels that have been scrapped, and even then, in some sectors, you haven't seen that much ordering. You also had...
How long does it take to get a ship? How long do these things last?
It depends on the type of vessel, but somewhere between 18 and 36 months is a useful guideline from the day you order it until it's delivered. It needs sea trials and everything else. Mm-hmm. So there's a lag in ordering vessels. And in terms of the shipyards, they've also mostly gone bankrupt. It's been a lot of consolidation. And a lot of the shipyards are booked steady for the next 2 years, putting scrubbers in. Even if you ordered a vessel today, where are you going to build it? Right. So you have this second gating function. You can't really order vessels. And what else has happened is that a lot of the guys who lended to the sector, they also went broke. So, those German banks that are in trouble, they were some of the largest lenders, as were a bunch of Korean groups and other banks that were really operating the shipyards as a make-work program. And they said, we'll lose a little bit of money on the lending side, and we'll make it up in tax revenue. Well, it turns out they lost a lot of revenue. They lost a lot on the lending side. And so you've had a lot of banks exit the sector. There's been a lot of bulk portfolio sales, been a lot of banks that say, we're just not going to do shipping anymore. Right. And so it went from you used to be able to borrow at LIBOR, maybe even less than LIBOR, because some state entity subsidized you to order more vessels. Now, if you want equity in the sector, you're going to have to do a 9% preferred. I mean, the cost of capital has increased quite dramatically on the equity side and on the debt side, which is another gating function. Charter rates are at multi-year highs right now, but no one's making money still. Right. It's just starting.
So talk about that. Talk about the peak charter rates and where they've come down to, and how much room for recovery there is.
Oh, wow. I mean, put it this way. I don't have the numbers in front of me, but for a quite long time, you could make more than $100,000 a day operating a Capesize vessel moving iron ore and coal. And, there's some peaks and troughs, and it's not like oil where, it's 55, give or take $2. And it's been that way for a couple months now. These things are very, very volatile day to day, week to week. Yeah. But use 100,000 as your guide point. And for many years, you could make 100,000 a day moving iron ore from Brazil or Australia to China. And then for a very long time, you're making 5,000 a day. That's revenue. It's costing you 10,000 a day to operate the boat. Very rough numbers. You have call it 6,000, 7,000, 8,000 a day to operate it. You have 1,000, 2,000 of SGA. Let's just call it 10,000. You have financing costs, a few thousand a day. You then have depreciation. That's a real cost when your vessel only lasts 20 years. You can't just EBITDA this. So you have a break even in the 15,000, 20,000 a day range, and you're getting 5,000 a day. I mean, just not all of that's cash, but you're just bleeding to death. Even now, we've had a very strong recovery, but capes are in the low 30s right now. Yeah, they're finally making some profit for the first time in almost a decade. I mean, think how far we've gone.
And think how much catch-up they need to make. I mean, they've destroyed shareholder value for a long time.
Right. At some point in the cycle, these things need to earn their cost of capital.
Yeah.
Which means you need rates to go much higher and stay there for many years to replenish balance sheets and start reordering. It's a cyclical industry. But, you're not just going to stop at cash break even. You need to pay down debt. You need to cover depreciation. I mean, I think, and you need to earn a return on capital. If you assume you need to earn a 10, 15% return on capital in this industry, why can't rates go back to 100,000 or 50,000 and stay there a few years?
So the shipping industry does not have a great reputation for management teams. I'll say I'm trying to be polite. I mean, right? I mean, over the last 20 plus years, I could think of how many shipping CEOs really are. People would argue that are not shareholder friendly sometimes. These are very closely held companies. So how do you now? They've been through some brutal cycles. How do they resist the urge when the cycle turns to just go out and do what they do in the hotel industry and any industry, in the cyclical industry? It turns, things start to get good, and they start flooding the market again with supply. What's your sense of where discipline is right now?
So I think there's two parts to that question. In terms of discipline, no one has any capital, so they can't flood the market. You need equity to buy a vessel. There is no equity available to anyone. You need another 6 months or a year before the first guys have enough equity built up in their balance sheet so they can start making orders again. It's a ways out. And then it takes 2 years to deliver a vessel. 3 years is a lifetime in shipping. Yeah. Remember, I've read some studies on this. Your average vessel lasts 20 years, and it's assumed that only 6 or 8 quarters in those 20 years, the vessel is actually profitable. You usually get 2 cycles in the lifetime of a vessel, and they last between 3 and 4 quarters each, maybe a little more. And that's all you get. And sorry.
No, go ahead.
And when you have those periods where those 6 to 8 or maybe 10 quarters, whatever, I've read a few studies on this. I mean, when we talk about excess profits, we mean excess profits.
You're talking, just crushing it.
Yes.
When they do, they have to. I was telling before you got here, a friend of mine said to me, he's a bank analyst, 25-year hedge fund guy, and he's looking at uranium. He's like, I got to tell you, I'm not sure these are great businesses. I said, dude, what are you smoking? Like, of course they're not great businesses.
They're terrible.
None of these cyclical industries are great businesses. These are deeply cyclical. It's human emotion. It's supply and demand. It's overcapacity. It's under supply, and you're playing the cycle. And he's like, okay, I got it now. But yeah, I mean, that's the thing. You don't get these they're not great businesses. And like you said, a handful of quarters where they have to over-earn because for those periods where they're struggling.
But when they over-earn, it's not unusual for them to make 50% return on equity each quarter.
That's right.
In one quarter, 50% return on equity, maybe even 100% return on equity. It's not unusual to do that multiple quarters. Yeah. Remember, you have operating leverage on top of financial leverage. Yeah. So when things are good, they're amazingly good. Yeah. And for people who saw the crypto bubbles of the last 2 years, where things went from some silly price to some other silly price because it's all made up, I kept telling people, wait till you see a shipping bubble. It's different orders of magnitude, even more crazy than crypto.
It's interesting. When as an investor, I've learned over the years that you don't have to own great businesses. No, right? Because Buffett, obviously,
I usually own crappy businesses.
You're right, but if you own a crappy business that's priced like it's dead, it just has to get back to crappy, and you can still make a lot of money. And if you own an okay business that's priced like it's dead or crappy, it just has to get back to okay. So things are mispriced sometimes.
Right, and with any cyclical industry, you don't know how far it's going to go. What you're just trying to do is say, is this industry beat down? Is it inflecting? Yeah. And then as the data points come at you, you can figure out how long you're going to ride the wave back up. And sometimes you only get 50% or a double at best. And sometimes you can make 20 or 30 times your money. I rode the last bubble. The last shipping bubble started for me in 2002, where after the Exxon Valdez accident, a bunch of global organizations mandated that all crude oil tankers have to be double hulled. And they set a deadline where basically everything else would be obsoleted. So there was this massive ordering of double hull vessels. So globally, everyone ordered too many vessels going up to the deadline, and they destroyed charter rates and bankrupted everyone. They took on a bunch of debt, ordered these vessels, and then all went bankrupt. That was basically what happened from 1999 to 2002. In 2002, the bankruptcies sort of abated, and you finally had enough scrapping of these single hull vessels leading up to the deadline. I think it was 2004, and it was a phased deadline, that charter rates started responding. And I was able to buy a couple of shipping companies at 20, 30 cents of the dollar of NAV. And some of these like Frontline.
He means net asset value.
Net asset value. And some of these like Frontline, 3 years later, my quarterly dividend was more than I paid for the shares. And I mean, Frontline was a 50 bagger for me in 4 years. It's amazing. Another company, OMI I owned, was a 20 bagger, and it was only a 20 bagger because they sold out too soon. I mean, the company put itself for sale. When these things turn, they're violent. And going back to your question about management teams, of course they're terrible. They're always greedy. They're always corrupted. They usually have minimal equity ownership. They're incentivized usually by how many vessels they own. It's a pride thing in Puerto Parejas to say how many boats you have. It's also a way to make money because you usually pay yourself a few $1,000s a day based on each vessel you have as a management fee, because you have a affiliated third-party manager that loots the company. There's a lot of conflicts of interest here, and you have to look past those conflicts and see where you are in the cycle. Right now, we're at the part of the cycle where all the corrupt Greek guys are in the open market buying shares personally. All the companies are buying back stock. Some of the most egregious guys like George Economicou from Dry Ships, he just took his own company private.
He did an MBO, right?
Right.
Buyout. And what sign is that signaling, right?
Right. A friend asked me, Harris, what do you think of the price? Did he get a good deal? I go, of course he got a great deal. And my friend goes, well, how do you know? I was like, I don't know, but this is a guy who destroyed his company issuing shares, and he just bought it all. He must have gotten a great deal. It's just common sense. And the other thing about shipping is that unlike something like property where changes in asset value are slow and gradual, you can have vessels appreciate in price very rapidly if charter rates go up. So you have situations where a Cape-size vessel, it's I don't know, $50 million to build, say today. I don't know, I have the exact numbers in front of me, but I think it was worth about $150 million in 2007. So it shows you what can happen to valuations as charter rates go up. And then, of course, as charter rates went down, the vessel depreciated in price, and it probably went from being worth $150 to $30 million a few years later. So you have this asset value that's appreciating and depreciating, levered 3 or 4 or 5 times. Plus, you have operating income. It's just pure leverage, which is why you have these 30 and 50-fold moves all the time in shipping sectors.
So we talked about IMO 2020 and what it's doing. And we talked about different sectors do well at different times. Does IMO 2020, though, does it blanket the whole shipping industry because of the
whole industry?
The whole industry.
It's going to be a gating factor for everything from ro-ros to capes to LNG. Just everyone has to comply on Jan 1. And I think there'll be a few months of chaos because certain ports don't have the infrastructure. They don't have the right fuels. It's worth noting that low sulfur fuel is not an actual fuel. It's a blend of different fuels. And various vessels, most vessels have engines designed to burn a certain fuel blend. And I think there'll be some mistakes where people put blends in that don't work with the vessels. There'll be a lot of problems and chaos. And shipping is great because disruption increases charter rates because you have a cargo that needs to be moved. And if the vessel you're expecting isn't there, you have to pay up for a different vessel to move your cargo. Remember, you're moving cargoes halfway around the world, and the total cost of moving it is fractions, usually less than 1% of the value of the cargo. So you can pay up 1, 2, 3 times. It doesn't really matter. You just got to move your cargo where it needs to go.
What impact has this had on the refinery industry, IMO 2020?
He might be going above my pay grade here, but there's been a lot of capital investments into refineries to get ready for low sulfur fuel. You've also seen big changes in trade flows. Oddly, America produces a lot of light sweet, yet most of our refineries are designed for Venezuelan crude,
which is heavy crude.
So what that's done is it's taken tanker rates up to begin with, because since Trump put tariffs on or basically stopped trade with Venezuela, we're searching other places further away for Venezuelan crude, and we're exporting our light sweet crude to people who are wanting that to refine it. So despite the fact that America produces a lot of crude, we're actually sending our crude very far away, and we're looking very far away to bring crude back home. It's just, you have refineries which are multi-decade operations making multi-decade capital allocation decisions, and then something like the Permian happens, or something like the trade war happens, or something like the issues with Venezuela, and it disrupts shipping. And that's why the other reason there's three reasons I'm so bullish right now. One is obviously because financing's been cut off as there's a new vessel building. The second reason obviously is IMO 2020, and then the third reason is the trade wars are amazingly bullish for shipping. Anytime you disrupt trade, it's good for shipping.
Yeah. So talk about that, because people's initial reaction is that there'll be less shipping. So talk about how you see it unfolding.
So let me use a statistic because I find this interesting. Number of shipping containers going into Long Beach, the port of Los Angeles. Every month this year, it's comp negative. In July, it comped -9. So it's comping very negative in terms of total trade. Based on that data, you would probably expect that container vessels would have charter rates down quite a lot because volumes are down a lot. Instead, charter rates are at 7-year highs. And this is a function of IMO 2020. This is a function of trade route disruption, because vessels are now going to Vietnam or other places that don't have the port infrastructure ready to load the vessels. So even though you're having a situation where the total number of containers is down 9% in July, in the month of July, we made new multi-year highs in container vessels. It's not just the volumes of trade that matter. It's the number of ton miles. It's port disruptions. It's anything that disrupts trade and creates bottlenecks is good for rates.
Liquid gas tankers.
LNG?
Yeah. What do you see there?
So I'm not particularly bullish on LNG tankers right now. I think everything will be good because of IMO 2020. And I guess my concern is that there's been a lot of ordering of LNG vessels. Mm-hmm. And it's much easier to build an LNG vessel than it is to build a liquefaction facility. And I think you're going to have a mismatch where the LNG vessels are probably not on time, but a few months late. And your liquefaction facilities might be 2, 3, 4 quarters delayed. And then you'll have gluts of excess vessels at a time when the spreads between nat gas in Asia and Europe and in Gulf of Mexico are contracting, which gives less arbitrage profits, less trade profits. There's kind of a glut of nat gas globally. And you've had a lot of these stranded nat gas projects that have come online with their own liquefaction facilities called FLNG. And it's just created this sort of glut of supply. Demand is somewhat down, and you have a lot of vessels coming. It's one of the sectors that has the most vessels, probably actually the most. And there's a lot of demand coming too. But I just think there'll be a mismatch in timing there. I have no exposure there, put it that way.
I know you have fund limits and how big a certain sector can be. Where does shipping rank in your fund?
Oh, we're at the limit. The good thing is the way I set my fund up is that, on entry, we can go to the limit, and then I have no requirement to cut it back. And with shipping as a sector that can multi-bag or upside, I'm just going to let this one ride. I think there's just massive upside in some of the subsectors.
How do you think about drawdowns when you look at a sector like that? So, I mean, even though everything fundamentally is turning in its favor, it can, with the market week tape, with a headline here or there, stocks pull back 10, 15, 20%. I mean, how do you think about upside downside when you're thinking about this type of stuff?
Well, when the sector's inflecting, the chart will tell you it's inflecting. You're going to have big, long base, and then it's going to start breaking to the top of the base. And when the news and the chart pattern converge and they both are doing the right things, then you get long. And there will be pullbacks. There will be some nasty pullbacks. In the 2002 to 2007 bull market, there were multiple 50% pullbacks. That's life. You deal with it. I always tell clients of mine that, let's take a stock. It goes from 20 to 60 and ends the year at 40. And, my client might say, wow, you just lost a third of my money. And I'm going to say, no, I doubled your money.
Right.
And,
right.
We're kind of both right. And if you can't handle that sort of pullback, then
you should be investing in cyclical industry.
Right. I mean, go buy a muni bond.
So anything else in cyclical land that has caught your fancy lately?
Well, you've kind of pulled me across the line on uranium. I think you're right. I really do. I don't know when it happens, but I think you're right. And I own some uranium participation, and I think it's going to be very good for me. I think it might just take a little longer than we both think.
Yeah.
It's interesting. We're a little different on that, just because I have some catalysts that I think in the fall with the contract. But it's always interesting in all of these turns. It's always sometimes you don't even see something coming, and it's the catalyst you didn't anticipate. That's good.
You never really know.
You never know.
So take dry bulk, okay? This is a sector that I'm not particularly bullish on because there's been a lot of supply of dry bulk, especially Cape. And so let me go back with dry bulk. You have dry bulk is basically...
Explain what dry bulk is to people.
So dry bulk is moving bulk products. So it's mainly iron ore and coal, but it's agriculture, it's cement, it's scrap iron, it's anything bulky. And there's lots of classes of bulk tankers, but the big piece of the trade that people always focus on is iron ore and coking coal. And so that's historically been transported in something called a Cape-size vessel. And there's a new class of vessel called a Newcastle Max, which is bigger, and it sort of obsoletes the Cape-size. And so there's been always this concern that Cape-size rates would be crushed by these new bigger vessels, and they sort of have been for the past few years. And so people have been very bearish on Cape-size, particularly because there was a lot of delivery in 2016, which led to a lot of scrapping in 2016 of older vessels. And you don't have a lot of older vessels right now that can still be scrapped. So people have been very bearish of these. And for most of the last year, they were trading at 5, 7, 8,000 a day. And it costs you 10,000 a day to operate the vessel before you have depreciation and interest cost. So everyone's losing money. But when a sector starts getting tight, and I have a couple of friends in the shipping industry that actually own these sort of vessels, and there's this thing called gapping, where you have gaps in trade flows, and suddenly someone who's trying to ship product is willing to pay up dramatically more because there is no vessel nearby. And so you have this thing called gapping, and I always have people flag it for me because it's important. It shows that a turn's about to happen. So despite the rates being in the toilet, it seemed my friends who own these vessels were starting to get really bullish, which means the industry is starting to get a little tight. And then going back to your point, you never know what the catalyst is. They started putting these scrubbers on about a month ago, and everyone budgeted 30 days. Well, it turns out it's more like 50 or 60 days. And it's not just big piece of capital equipment that no one has any experience installing. It takes longer than expected. But it's not just that. It's that they had very clear timelines. You're going to show up at this Korean port on this day. The next day, you go into dry dock. And in 30 days, you are ready to go for repositioning for a cargo. What it did is it destroyed everyone's schedules and everything. And you have hundreds of vessels queuing outside Korean ports as opposed to moving dry bulk around, which is why Cape-side vessel went from 5,000 a day to like 33, 34 a day. And the sector just it goes up another 1,000 or 2 every day because more and more of these vessels are just queuing at Korean ports because they have no shipment schedule. They weren't trying to schedule anything. It's too expensive to reposition them back to Perth or somewhere else. They're just going to sit there and wait. And you just have this giant, I think the technical term is clusterfuck.
Yeah, no, that's technical. That's official. Clusterfuck is an official term.
And but you never know what makes a sector go tight. And then the issue is, if you have steel mills that start drawing down inventory, then it's not like this short-term thing, and then it's just done when everyone gets their scrubbers. You need to still replenish all this inventory. So it's probably going to get tighter. Rates are probably going to go higher before it starts normalizing out. And we're only in like the second or third innings of installing scrubbers. This might go for 2 years. Yeah. And I mean, you might make enough money in the next 2 years to pay for all your boats. Yep. Which is amazing when you think about it. You look at a piece of property and you're going to get a 4 or 5 or 6 cap, and it's 25 years to pay it back. And here you have a cape size, and depending where rates go, you might pay the whole thing off in a year.
I know talk about one of the names you liked, which is one that I've actually written about in my newsletter, but I think is very interesting that you like, and you turned me on to it, was Scorpio Tankers. I think it's one of your bigger positions. So why don't you talk about Scorpio?
So that's my largest position. I've been following Scorpio almost since the IPO in 2014. It's always seemed like a great idea. I just knew the timing was wrong because I went through the double hull tanker trade in the early 2000s. Scorpio is a product tanker. They're the largest product tanker fleet globally, the youngest fleet, about 2.5 years. Their whole fleet will have scrubbers on it by the end of next year. Product tankers move refined products around. And the reason it's so interesting is that globally, you're going to need about 3 million barrels a day more low sulfur refined product starting January 1. Mm-hmm. And so you're going to have this shift where vessels don't burn high sulfur. So you're going to have a lot less demand for dirty tankers and a lot more demand for clean tankers, which is what a product tanker is. And depending on whose research you read, it's somewhere between 5 and 15% increase in demand. Because it's not just the 3 million barrels that needs to be moved. It's all the ton miles. You don't think of it in terms of volume moved. It's ton miles moved. So you need to resupply all these ports. You need to build up new trade routes that don't exist today. You're going to have bottlenecks and disruption and general chaos. And so when you have that sort of a change in a sector where you haven't seen much new supply coming over the next 2 or 3 years, rates should do something crazy. I knew from my double hull tanker experience that if you played it too soon, you'd get hurt. They ordered a lot of product tankers in preparation for this, and rates were in the toilet for 3 years. And anyone who owned a product tanker lost a few $1,000s a day, every day, 365 days a year for multiple years. Companies like Scorpio had to raise capital multiple times to keep the lights on. And then it started turning. Last November, we saw a turn where rates went from losing a few thousand a day to making 10 or 20,000 a day. It was a short-term blip, but it showed that there was an evening out of supply and demand because there's very little supply coming right now. Just because people lost money at this for so many years, they stopped ordering. You also have an issue where a lot of older vessels, because the coatings have been scrapped at a younger age, or if not scrapped, they start trading in the dirty markets. So you have basically a 15-year-old age for these vessels versus 20 for other vessels. And so you've seen a bit more obsolescence. And what's going to happen on January 1 is demand should increase quite dramatically. What you see in shipping a lot, before you see a super spike, is you see a few short spikes. So we saw one in November and December. You saw another one this spring where you went to 5-6 year highs in rates. On average this year, rates are about 10,000 ahead of last year. So you take like an LR, it's doing about 20,000 a day on average versus 10,000 a day last year. So it's actually making a bit of money, not a lot, but it's making a bit of money now. And when you start comping positive year over year, you know things are starting to get better. But this is all getting better before IMO 2020 kicks in, when demand's going to kick in quite dramatically for these vessels. My thinking is that you might see charter rates go to some crazy number. I mean, why not in the first couple months of disruption? Why can't charter rates go to 100,000? I mean, back in 2007, 8, they were there. I mean, why can't we go back there and stay there for a couple months? Maybe even stay there a few quarters. I don't really know. But at those sort of rates, Scorpio might be able to earn, it's a $25 stock today. I mean, why can't Scorpio earn $50 this year? I mean, it sounds crazy to say, but I mean, why can't it?
Everything's done on a spot basis.
Scorpio's 100% spot.
100% spot. Throughout shipping and Scorpio and others, how do you think, how much ever gets locked up through contracts and longer term stuff?
Actually, most of the fleet is locked up through contracts. It's kind of rare to be spot. It's kind of rare to have a company that's all spot. Mm-hmm. The danger of being all spot is that if you guess wrong, you can lose a lot of money. Yep. Which is what happened to Scorpio. Yep. They were bullish too early, and they raised capital every year, once a year, and diluted everyone. But most shipping is done on multi-year contracts, or their contracts, sometimes they're fixed contracts, sometimes they're linked to an index and partly fixed, a lot of variations, but it's rare to go on spot. I don't have exact data in front of me as to, but my understanding is that a good chunk of the global fleet is fixed.
There's a way to figure out uncovered contract demand looking forward? Like in uranium, I could look at the utilities and know by region, right? How much uranium needs are not covered by contracts and when those contracts are rolling off. What kind of visibility do you have on that?
I've never seen any research on that, actually.
Okay. That's interesting.
I do know that if you look at where contract price is, so take an MR, okay? Right now it's doing about $12,000 a day. And if you were to sign a 1-year contract, you're going to get around $19,000 to $20,000. So the contract price is quite a lot higher than today's price. Remember, the guys signing these contracts, they're the Vitols and Trafigura and Glencores of the world. They tend to be the smart money. Yeah. So if they're willing to pay you $19,000, they think they're getting a good deal. And right now they're getting 12. So they think at some point in the next 12 months, it's going to be dramatically above 19 to offset the fact that at least this month they're below 19. Right. So, it kind of tells you where the forward market is. And the forward market tends to be rather accurate. Not so much that the average over the next 12 months will be 19,000.
It's not in uranium, but
but it tells you the direction people are thinking. Yeah. So if the forward market is below the spot, it tells you people expect it lower, above, and you can see the forward. It's been creeping up for many months now, while spot's had a few spikes, but it hasn't really been creeping up yet. Right. And so it's just like an indicator of what's going to happen.
So you mentioned a lot of the shipping industry tends to be Greek owned. I don't know what percent, but a fair amount. When you think of shipping, you think of big Greek families and dynasties. Shift gears for a second. I know that you had mentioned to me in the past that you think Greek is interesting as a country from an investing standpoint. What's the thesis there?
So outside of Argentina, I don't think any other country, outside of wartime, has destroyed their economy as much in the last 90 years. Greece joined the EU. They got really cheap debt as a result. They went crazy and spent a lot of money and borrowed a bunch of money from everyone who would lend them money. And in 2008, they went broke. And then they went broke again. And they went broke again. They got bailed out. They went broke. I forgot how many bailouts there were, but effectively, Greece is a small country. All the banks lent to all their buddies. Their buddies refused to pay them back.
Are they still buddies?
Yeah, of course. But this just giant mess created with too much debt. And the ECB came in. They say, we're going to fix this problem. We're going to have austerity on top of debt. And all that did was basically destroy asset values, destroy businesses. And you had this deflationary spiral where the GDP lost 25% over a 10-year period, which is amazing when you think about it. Yeah. Wages went down, unemployment went to like 30%. The Greeks didn't help because about halfway through, they decided they were going to try drachma, and then they changed their mind, and they decided they were going to try it again. They had an election. They threw some Molotovs at each other. No one wanted to put money in. The banking system, all the capital basically left the banking system. They had exchange controls. It was just a giant mess of a country. And the stock market's down.
Wonderful people and beautiful country, though. Oh,
I love it there. Yeah. Great food. Everyone's friendly. Everyone's drunk at all times. But you had the stock market down something like 90-something%, and the banks all had 3 bailouts. And so I went there 2 years ago looking for opportunities, and it was all bombed out. And I just had this feeling that I wasn't ready yet. Just because something's cheap doesn't mean anything. You need a catalyst. And there was no catalyst. the government was still doing stupid stuff, and you had no idea where the ECB stood or anyone else stood in terms of what was happening. But while I was there, I had this odd experience in that I met the very senior guy from the opposition political party, New Democracy, and he invited me to their office. I still don't know why. And we talked for about 2-3 hours about economic policy. And I came away saying, if these guys ever win an election, I want to buy as much Greek exposure as I can. Their whole platform was basically get rid of dumb regulations, cut taxes, and stop a bunch of projects that have been stalled out, highway and power plants and all this other stuff. And so about a month and a half ago, 2 months ago now, they called a snap election. And I looked at a quick snapshot of where the polling was, and it seemed very likely that New Democracy is going to win. And I bought a very large position in the Greek ETF. I think it was up 10% the day they announced the snap election, and I didn't really care. I just bought it. And I'm up about 10% since then, which is reasonably good, I think, considering that the rest of EM has been obliterated. Yeah. I think most of the EM's down like 20% since then. I'm up 10. So had EM just held in, I'd be up a lot more. But New Democracy won. They're doing all the right things. The July government budget data came out. Tax revenue's up 8% year over year, which is kind of crazy when you think about it because Greeks don't pay taxes. The economy's doing quite well. They finally lifted exchange controls last week. He's been the prime minister's been pushing around the edges, but he's lowering the tax rates from I think 28% to 24%. And the Germans aren't really happy with him, but they seem to be letting him do what he wants, which really is the first step in terms of, I think, the rest of the Eurozone following. They've taken monetary stimulus as far as it possibly can go. I don't know if you go from minus 40 bips to minus 60 bips or minus 100 bips, it's going to do anything else. They need fiscal stimulus. And I think Greece will be the litmus test for what can be done with fiscal stimulus. But as they start fiscal stimulus on the tax side and also infrastructure, I really expect the Greek stock market to come back quite a lot. As I said, it's down 90%. I've always found that most money is made when something goes from down 90 to down 70. Yeah. Because, you triple your money. And I have this saying, when it goes from really shitty to sort of shitty is, the most profitable part of the cycle. I don't expect Greece to be Singapore. Don't get your hopes up too high. It's still Greece, but I think there's going to be a great run here. Look, if the Argentine ETF in US dollar terms could more than double during a time when Macri basically accomplished nothing in his presidency and had runaway inflation and just made a mess of the thing, why can't Greece at least double? I mean, they're in euros.
How do you get your ideas? What drives your process? Talk about your investment process, your idea flow, kind of work you do to get you comfortable with something.
Well, idea generation isn't very hard. I am amazingly lucky in that my friends are all smarter than me. So I
thought I was the only one who had that idea.
Well, I mean, how many times at midnight am I texting you about uranium? So having really smart friends.
No, I thought I was the only one who also had smarter friends than me. Is what I meant.
Oh yeah, okay.
Yeah.
But I get most of my ideas from my friends. My friends share. I always say that the best way to make money is going out to beers with a friend and just asking them what they're down on that they still believe in. Yeah. And if I could buy in at 20 or 30% less than someone really smart paid, I've already got a built-in edge. And that's usually the first part.
That's so true.
And especially because there's so much in this earth to follow and keep track of, I just don't have the bandwidth. So if my friends have done most of the work and they can point me in the right direction and save me a month of work by just giving me the 10 key presentations to read, or it just makes it so much easier. And I hope to return the favor in shipping, because I know most of my friends don't look at that, but that's the best way to find ideas. Outside of that, look at what's down a lot. Yep. Go to a bunch of message boards, value investor clubs, Seeking Alpha, those sort of places. I just read religiously. I work 15-hour days, and all I do is read all day.
You travel a lot too for work.
Oh, I travel a lot too.
Talk about that. What do you do? Where do you go? When you go somewhere, you're going to look at companies. You're going to talk to Greek minister officials. So you set it up. Do you go and just wander and get a feel? I know you were just in Kyrgyzstan recently.
I was in Azerbaijan just recently.
Azerbaijan.
Every trip's different. I mean, I like to do disaster travel. I'm usually going to see civil wars and revolutions.
Right. Were you also a war photography major?
No.
Double major?
The only civil war I've been to actually is Ivory Coast. So we got held up at gunpoint by some 7-year-old boy soldiers, and I decided I didn't want to do that again.
Yeah.
But no, I travel a lot. I have a lot of friends, so I usually just piggyback on their travel ideas. The trip to Greece originally was my very good friend Sasha, who said, "Let's go to Greece. It's bombed out, and I think it's going to recover soon." I said, "Sounds good." And we all went through our Rolodexes, and I had a few people I knew in Greece. He did too. And pretty soon you have a week of meetings in Athens between hedge funds that are in Greece, banks in Greece. It's amazing, especially in your country that's so bombed out that you don't have a lot of hedge funds visiting anymore. And the ones that are visiting are usually short sellers. When you come and you say, "Look, we're looking to buy stuff," it's amazing who's willing to meet you. Like, my fund isn't that large, but I met with all 4 systemic banks, and I met with the CEO and the CFO. I mean, think of the access we got. It's just amazing. We met with the number 2 guy or so in New Democracy. They were just so surprised we were there.
Yeah.
I was just in Cyprus a few months ago. I met with Bank of Cyprus. They were amazingly open and happy to take a meeting as long as I wanted. I'm always amazed at how much time people will give you of their time. But I usually travel with a couple friends. The danger of going to a meeting by yourself is you walk out and go, "Man, that was great."
100%.
And, you need a friend to kick it around with you, because about 20 minutes later, you're like, "So what did he mean by that?" And, you should have 2 or 3 people. Someone will find the flaws in the meeting. And besides, it's just much more fun that way.
Yeah.
Because when the meeting's done, you type up your notes and you hit the bars and you go discover a country. Because, Greece isn't, to me, just the banking system. It's everything else that's going around there, because the banking system needs the rest of the economy to support it. So you have to get a sense of what's happening. And I always find the best information comes from the local bartenders. They know what's going on.
Sure do.
You just talk to them, taxi drivers.
Taxi drivers are phenomenal.
Yeah.
Yeah.
And you just learn, you just figure it out.
What, any countries, any regions of the world you won't invest in?
Oh, I'll invest anywhere.
Yeah. What's your worst investment? Like what, because I have plenty. But what do you learn from your mistake?
So let's take something. It's not a mistake yet because it's not crystallized, but stock called Antero, nat gas company that I own shares in, and I have some calls and call spreads as well. It's been my worst investment this year by far. I think it's down like 70% from where I bought it. The lesson was it's really, really cheap, but the macro hasn't worked with me. I took this view that they're fully hedged 2019 and 20 on nat gas, and 21 and 22, they're partly hedged. Mm-hmm. So it doesn't really matter what happens to the price of nat gas because they have zero exposure to it. And what I missed was that most people in the stock market are retarded, and they're so focused on tick for tick with nat gas, especially with all the computers that just trade it all like it's one, nat gas derivative, that the computers miss the fact that these guys are hedged and no one else is. And so the stock's down quite a lot. And, I think my mistake was overthinking it and saying, these guys are going to be okay and everyone else won't. What I really should have done is wait till everyone dropped, because they're all going to drop together with nat gas, and wait until the first couple of bankruptcies happen, like I did with shipping, and wait until supply starts getting constricted a little, and then gone to the one guy that's hedged. And I was probably, I am 9 months early in the trade. And I think that's the mistake, is you got to wait until it's actually turning. You can't just go in there and say, these guys are protected, so I don't really care what happens to the underlying. You have to wait until the underlying itself is turning too, because you'll get a better entry price.
So when you think, all right, so it's down 70%. When I don't use stop losses, I think they're ridiculous personally. I should, on shorts,
on shorts always.
Yeah. I'm okay with that. But But on longs, if the thesis is right, you get a drawdown and you're buying it cheaper. If your thesis is right, how do you think about that managing risk?
So my view is you set a certain percentage of your portfolio for the position you want to own. And as it goes down, you take it back to that weighting. So let's say you set stock at 10% of your portfolio and the stock drops 20%. Well, you can add 200 basis points more of your portfolio to get yourself back up to that 1,000 dips you want to be, which means you're going to always be averaging down. It works marvelously when the stock recovers because you've taken your cost basis way down. And then on the first nice recovery, you'll take some off the table, get your average weighting much lower. It works terribly if a company goes bankrupt. You'll end up dumping your entire portfolio in.
But at least you know where it could go to zero, right? I mean,
yeah. And it doesn't matter how much cash is in a company. It doesn't matter what you think you did on your due diligence. There's fraud in the stock market. Stuff can always go to zero. You never want to bet your whole portfolio on anything. And so you do this with a scale and you say, I'm going to keep averaging in. And you really hope it doesn't go to zero. And part of that is your due diligence to make sure the balance sheet is robust enough to survive whatever can go wrong. And, it's finding obvious points where it makes sense, where you have some sort of catalyst to add. You're not just going to, sometimes you just scale in every 50 cents down, we're going to add another 100 bips. But much more likely, it's you're waiting for some sort of catalyst where you think there's an inflection coming.
How do you start your position sizes, and what's a medium size and a big size position for you?
So I run a super concentrated fund. I do something that no one else does these days so most of the asset management industry basically tries to create the ETF and track whatever index they are because they don't want to have a tracking error and they don't want to have drawdowns. So they have a very diversified book and they effectively have
no alpha.
They have the index minus lag from fees. My portfolio is 6 to 12 of my best ideas. So it's very concentrated. My average position size is 10, 13% around there. I do not do positions less than 5%. I just don't believe in it. The only time I'll ever have less than 5% is because I never got my full position filled, in which case I'll usually just toss it because I've learned that position number 13, I don't have the bandwidth to keep track of. Something bad will happen and I'll miss it.
And if you are spending a lot of time on it, that means there's something wrong, right?
Yeah. I've found the positions that you spend the most time on are usually the ones that you're totally wrong on. Yeah. It's funny. Shipping is 35% of my book right now. I put almost no time into it. I check because
you did the work already. You understand it, yeah.
But I also know I'm right. Yeah. So I check the charter rates in the morning, and I check some news from a couple shipping newsletters, and I'm done. I don't think about shipping because it's going in the right direction. I know I'm right. Something like Antero, man, I spent a lot of time trying to figure out why it kept going down, and there kept being surprises. There was NGLs were blowing out. Then there was basin differentials. It just stuff kept happening. But going back to your question, I run a very concentrated position book. You don't have a lot of room for many errors when you only have 6 to 12 names.
All right, so let's play a little word association.
Okay, wow.
Yeah. We got to wrap this up, Garrett. I know. Favorite country to travel to?
Oh, I loved Iceland. Loved Greece. New Zealand. Those are the three best.
Best investment ever made?
Uranium.
Yeah. 20, what year? 2004?
2003. I was looking back on this. I think my worst one was a 10 bagger, but some of them were like 30 and 50 baggers. I owned a few million shares of Laramide. There was this guy, I don't even, is James Dine still alive?
Oh, yeah, he is. Yeah, the newsletter guy?
Yeah. He was like 90 back then.
Yeah.
Well, he came out with an alert, and Laramide had always been kind of a laggard, and I had a few million shares, maybe like 5 million shares. I was trading at like $1. And he came out with an alert to his subscribers, you have to get into Laramide. And the stock was indicated at 100. It was trading like $1, and I had 5 million shares. And it was halted for almost 2 weeks. They didn't know what to do in the exchange.
Oh my God.
I think I had 99 of it. I think it opened at like 7 or something, but it was still like, I don't know. It was
a 7-bagger overnight.
Yeah, like multiple millions of shares.
Yeah. What's your worst investment?
Oh. I've seen some junior gold miners go to zero.
Yeah, that's not uncommon. What? Who are three people in the world you'd like to have dinner with?
That might take me longer. I don't really know.
All right. Where do you hang your hat?
Oh, I live in Miami.
How long you been down there?
15 years now.
Yeah, you like it?
Yeah, South Beach is great.
Yeah,
it's great.
What keeps you up at night, portfolio-wise, investing-wise?
So I have a small little hedge right now. It's a couple percent of my book in IWM puts, and I think it's like 300 bips or something. And that 300 bips is the scariest part of my book, even though it's puts, because I hate being short. Yeah. And my long book, I don't really worry because everyone's profitable. They all have big buybacks in place, and they're all growing fast. Good things will happen to them. I'm worried about the short book, that those 300 bips go to, put heaven because Trump tweets something tomorrow.
Yeah. Thoughts on Tesla, Elon Musk?
Oh, I kind of, let me take this in a different angle, a different direction than other things I've said on Tesla. I give him credit, actually. He's taken this fraud a lot further than I ever thought was possible. When other people would have just jumped off the boat and sold all their stock and gone into hiding in Mexico, he's created new and more creative frauds to overlay over the existing fraud. And he's found, what's the market cap? Like 30 billion? He's found like 30 billion of the dumbest money that ever existed. I mean, these are guys who even SoftBank wrote off as being, too dumb. And they just believe anything he says. I just don't get it. I know it's going to die. I just don't know when. But I have 2021 paper in June. So it's going to cost him about $10 billion between now and then, between operating losses and refinancings. And that's a lot of money, even in today's low interest rate world, that he's going to need to find.
Is there anything he says that you believe? Business-wise?
Business-wise. No. I mean, he just compulsively lies. I don't think he even knows the truth most of the time, which is somewhat odd. The whole thing is fake. It really is. I mean, I just don't get it.
All right, man, we're going to wrap it up. Thanks for coming in. I appreciate it.
Yeah, thanks for having me on.
Yeah, you bet. Well, I hope you enjoyed the hour plus we spent with Kuppy. He was kind enough to come in to the office and sit here while we recorded. And now he and I are going to go have a beer. So have a good week, and we'll talk to you next week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.